afternoon and welcome everybody. My name is Ron Scharnberg and I'm here with John Lobb, and we are in our first part of a three-part series where we will be discussing tax reform as it relates to international tax issues. So welcome everybody to the presentation. This first part is going to be discussing the transition tax and then the introduction to the new Quasi Territorial tax system. As mentioned, my name is Ron Scharnberg and John Lobb's here with me today. And if you have any questions during the presentation, please email them to Megan Green, and we will answer them as soon as possible following the presentation. And her email is listed on the slides at megan.green@bakerbots.com. The most important thing is the CLE credit, and so the code for the CLE credit will be announced at the end of the presentation. Please include this code on the affirmation form, which you can download in the reminder email, which was sent to you yesterday. And if you do not have this form, please email Megan Green, again, at megan.green@bakerbots.com. So now we'll begin the presentation. So just as a little background, as I'm sure most of everybody's aware at this point, but on December 22nd, 2017, President Trump signed into law the Act to Provide for Reconciliation pursuant to Titles 2 and 5 of the Concurrent Resolution on the Budget for Fiscal Year 2018, which we will informally known or call it as the Tax Cuts and Jobs Act of 2017. And for purposes of this presentation, we'll refer to it as the Act. But the title had to go through a name change due to budget type issues in connection with passing the actual law itself. So the Act is the most significant overhaul of the Internal Revenue Code in basically the last 30 years. And then in general, with respect to the international tax, the Act does several things. First, it imposes a transition tax, which basically acts as a toll charge in connection with moving to a quasi-territorial system for C corporations. It then reduces the U.S. corporate tax rate to 21%, and in conjunction with that, it creates a participation exemption that moves the United States to the quasi-territorial system for C corporations. And then finally, the most important, or one of the other principal things that the Act does on the international tax side is, in connection with that movement to the quasi-territorial system, it then introduces several new measures to help prevent base erosion. And those measures are GILTI, FDII, and BEAT. And part 2 of our presentation, which the webinar will occur in 2 weeks, we'll discuss GILTI, FDII, and BEAT in more detail. So as we walk through this first part, the important, I think, takeaways that you'll get, or hopefully get from this webinar presentation, is that there's now, as we've discussed, a transition tax of 15.5% on EMP attributable to foreign cash, and then 8% for all other previously untaxed EMP, and that's imposed on 10% U.S. shareholders of either CFCs or non-CFC, non-PFICs that have at least one corporate 10% U.S. shareholder. The Treasury Department and the IRS have been moving quickly with issuing guidance on the transition tax, since that is the most pressing need in the international tax area. And such guidance actually includes a restriction, a recent guidance includes a restriction on the ability to have made a tax year change from a calendar year ending 2017 to a year ending before then. So there may have been an attempt to potentially, I guess, defer, in essence, the transition tax by making a calendar year tax change to a fiscal type year. And if that was done with respect to a calendar year ending 2017, there's recent guidance that restricts that ability. Another important takeaway as we walk through the new quasi-territorial system is the ultimate income gain in EMP related to foreign subsidiaries and business activities that are subject to this new participation exemption in territorial system can actually be significantly limited by GILTI and Subpart F. And in essence, that moves you away from, a pure territorial type system. Another kind of important feature is that actually, it doesn't necessarily make a lot of sense, but Section 956 is still applicable and will ultimately override the new participation exemption if it does in fact apply. And then as we'll walk through some kind of structuring ideas or look at different structures in connection with acquisitions and dispositions, another kind of important feature is that ultimately, due to all the new features of the tax reform, modeling the anticipated after-tax consequences of the alternative structures will be even more important than probably they existed, pre-Act. and that's largely due to the fact that there's just a lot of interplay between a lot of the different issues that are present now with respect to having guilty and beef and some of these other measures. So as we walk through this webinar presentation, we're going to have some illustrations on these slides, and just to kind of give you an overall legend. If you see a rectangle, that's going to signify a corporation. If you have a triangle, that would be a partnership. An oval circle would be a disregarded entity, and then if you have a gray shape, that's a U.S. entity, and if you have a red shape, then that will be a foreign entity. So with that said, now we'll walk into Section 1, which is discussing the transition tax, and I'll turn it over to John.
Thanks, Ron. So, as Ron said, the first topic we'll get into is the transition tax. And so, just as an overview, as Ron touched on, the Tax Reform Act moved the U.S. from the prior system, which was a worldwide tax system where a U.S. person's worldwide income was subject to U.S. tax, to this new Quasi Territorial system where, in certain cases, a U.S. person's foreign income is not taxed in the U.S. Under the old system, U.S. persons could, in certain circumstances, defer U.S. tax on their income by earning that income through a foreign corporation, and those earnings would be taxed only when the earnings would be distributed back to the U.S. shareholder. So as part of this move to the Quasi-Territorial system, the Act imposes this toll charge or transition tax on the earnings that were earned under the old system but had not yet been subject to tax. So the mechanism for imposing this transition tax is to increase the Subpart F income of foreign corporations that had deferred earnings, and then requiring 10% U.S. shareholders of the foreign corporation to pick up an income, their share of that foreign corporation's additional Subpart F income. The inclusion, which is under Section 965 of the Code, is it's taxed at a reduced rate, either 15.5% or 8%, depending on whether the inclusion is attributable to cash or other liquid type assets of the foreign corporation. So getting into specifics, the first key issue to look at under the transition tax is identifying which corporations and which earnings are subject to 965. So the first key term is deferred foreign income corporation, and the general rule is a deferred foreign income corporation is required to increase Subpart F income for its last tax year beginning before January 1, 2018 by the greater of its accumulated post-86 deferred foreign income as of November 2, 2017, or its accumulated post-86 deferred foreign income as of December 31, 2017. So there are these two measurement dates in the code, and that's one way that Congress was trying to address concerns that taxpayers would kind of anticipate that there'd be this deemed repatriation as of the end of the tax year, and so would try to do something, transaction between November and the end of the year to wipe out those earnings. And so by requiring an inclusion for the earnings, the greater of the earnings as of November 2nd or December 31st, that is one way that prevented that kind of transaction from having an effect. So kind of looking closer at what is a deferred foreign income corporation. So with respect to a 10% U.S. shareholder, it means any specified foreign corporation of that shareholder that has positive accumulated post-86 deferred foreign income. Well, what is a specified foreign corporation? Well, that's any CFC or a non-CFC, non-PFIC foreign corporation that has at least one 10% corporate U.S. shareholder.
So John, I guess as we look at these definitions and just looking at the context of this transition tax, I guess one of the important things or features of it, at least to me, it seems to jump out, is that, you know, although what we're really moving to on the territorial side is really for C corporations, the way that these all kind of interplay, you can get basically any 10% U.S. shareholder, which would be individuals, partnerships, other flow-through type entities that could be subject to this transition tax, as long as it meets one of these requirements, which is it's either a CFC or you have at least one domestic corp that's a 10% U.S. shareholder.
Right, absolutely.
Okay.
Yeah, so, you know, kind of in addition to the rules being written broadly enough to pick up a broad range of U.S. shareholders, another change in the Act broadens the definition of a CFC, or what kind of companies are picked up as CFCs and who's picked up as a U.S. shareholder, and particularly because the Tax Reform Act repealed Section 958B4, which is one of the constructive ownership rules that formerly applied for purposes of determining whether a foreign corporation is a CFC and whether a U.S. person is a U.S. shareholder. So prior to tax reform, 958b4 would prevent the stock of a foreign sub from being attributed downward from its foreign parent to a U.S. sub. And so that rule allowed for so-called decontrol transactions where you had a foreign company acquiring a U.S. target, and the U.S. target had CFCs, and after the transaction, the foreign parent would make a direct investment in the CFC and take back enough stock to cause the CFC to no longer be owned a majority by 10% U.S. shareholders, and in effect then would cause the CFC to no longer be CFC and avoid subpart F. But that rule now has been eliminated, and just to show kind of a simple example, you have this structure where you've got foreign parent owns 100% of U.S. sub, and then U.S. sub owns 9% and foreign parent owns 91% of foreign sub. So prior to tax reform, this structure would be effective to cause foreign sub to not be a CFC because you had U.S. sub as a 9% shareholder and the 91% that's owned by foreign parent would not be attributed to U.S. sub. However, because that attribution rule is now gone, the stock of foreign parent, or the stock that foreign parent owns in foreign sub is attributed downward to U.S. sub, meaning U.S. sub now is the 100% owner of foreign subsidiary constructively. So foreign sub is now CFC, and moreover, U.S. sub is now a U.S. shareholder because it owns 100% directly and constructively. One point to note, I think that's important, is that, you know, although the U.S. sub is the constructive owner of 100% of the stock of foreign sub, when you look at the actual inclusion it has to take into account under subpart F, the subpart F inclusion is only U.S. shareholder or U.S. sub's pro rata share based on its direct and indirect ownership in foreign sub. So even though it's 100% constructive ownership, because it's only a 9% direct or indirect owner, when it picks up subpart F income from foreign sub, it only takes into account its 9% share. It doesn't have to take into account 100%.
But I guess which is a very good point, but also I guess on this point though, that since these rules, or this CFC rule and the downward attribution was made effective for the last tax year ending before January 1st, 2018, that you can capture these type of structures under this transition tax. Is that correct?
Right, absolutely.
Okay.
Yeah. So continuing on with discussing what it means to be a deferred foreign income corporation. So the deferred foreign income corporation has to have positive accumulated post-86 deferred foreign income. And what that means is that's basically any post-86 E&P of a specified foreign corporation that has not yet been subject to U.S. tax. So basically it excludes any E&P that's attributable to effectively connected income or is PTI that's previously been picked up under subpart F. And post-86 E&P, as used in that definition, is accumulated E&P in post-86 years during which the foreign corporation was a specified foreign corporation, but importantly without reduction for dividends distributed during the year. So that was another way Congress intended to attack situations where taxpayers were able to make distributions during the year to reduce the deferred foreign income amount. So the post-86 deferred foreign income calculation is kind of the baseline of the 965 inclusion. So the transition tax rules also do allow taxpayers to reduce their inclusion by deficits in certain cases. So in particular, if you have a U.S. shareholder that has at least one deferred foreign income corporation and at least one E&P deficit foreign corporation, the shareholder can reduce the 965 inclusion by the aggregate foreign E&P deficit. So for these purposes, an E&P deficit foreign corporation is generally a specified foreign corporation with a deficit as of November 2nd, 2017, the first measurement date. And then the aggregate foreign E&P deficit means specified E&P deficits up to the amount of the post-86 deferred foreign income, and specified E&P deficit is just the E&P deficit as of November 2nd, the first measurement date. E&P deficits need to be allocated among the U.S. shareholders, deferred foreign income corporations, and the allocation is based on the deferred foreign income corporation share of the deferred earnings. So basically each deferred income corporation gets a proportionate share of the deficit in proportion to its overall share of the deferred foreign income. And for this purpose, deficits includes kind of any E&P deficits, including like a hovering deficit that would otherwise be limited in the kind of E&P it can offset.
Okay, so I guess now that you've talked about how you do that allocation, let's just walk through a simple example, I guess, to illustrate. So if we look at this, if we look at the screen now, you have a U.S. parent that has 3 CFCs. CFC 1 is a post-1986 deferred foreign income corp, so it actually has, you know, positive E&P of 900. CFC 2 is also a deferred income corporation, and it has positive E&P of 100. But then we have our deficit CFC, which is CFC 3 of 200. So if we look at this, you know, technically now under these rules, CFC 1 and CFC 2 are the deferred foreign income corps, and CFC 3 is the deficit. So U.S. parent has an aggregate E&P deficit of 200 as a result of the CFC 3. And so under the allocation formula that you just walked through, you basically look at, or you allocate it based on the pro rata amount of the foreign income corps. So therefore, here we have 200 of aggregate E&P deficit, so we multiply it by a fraction, which is 900, then divided by 1,000. So that would allocate the deficit 180 then to CFC 1, and then 20 to CFC 2 under the same formula, but now it only has $100 of income. So ultimately, then, whenever you look at the inclusions that are 956, for CFC 1, you have 900, subtract the 180, and now you're at 720, and then the section 965 inclusion for CFC 2 is 100 less the 20 that was of the deficit that was allocated to CFC 2, and therefore you're left with an overall inclusion for CFC 2 of 80. So that's just the methodology that as you walk through under a simple example.
Right. So a question that had come up pretty quickly after the tax reform law was released was, how do you order the different inclusions and different distributions? You know, you have kind of regular subpart F income, foreign personal holding company income, foreign-based sales company income, et cetera. You know, you have this new 965 subpart F income, and then you have what if the company makes actual distributions during the year? How do all the ordering rules work together? And so the IRS, recognizing that, issued in Notice 2018-7 an intention to issue regulations that walk through the ordering rules as they'll apply. So first, U.S. shareholder will include in income non-965 subpart F income. Then the rules will take into account distributions that one deferred foreign income corporation makes to another specified foreign corporation to avoid kind of double counting issues. And third, 965 amount gets taken into income by the U.S. shareholder. And fourth, if there are actual distributions during the year, those get picked up under as PTI to the extent that there's been kind of a prior inclusion. And then finally, the 956, which, as Ron mentioned at the beginning of the presentation, is still, for some reason, in the code for all U.S. shareholders, so that amount then gets taken into account. So we talked about kind of computing the amount of the 965 inclusion. So how is it taxed then? So the 965 inclusion is subject to tax at reduced rates, and the rates will depend on kind of the underlying assets relating to the earnings. So first, there's a 15.5% rate applicable to the amount of the inclusion that's attributable to the U.S. shareholders' aggregate foreign cash position, and then the rest of the inclusion is taxed at a lower rate of 8%. The Act gets at those rates by allowing the U.S. shareholder a deduction based on an assumption that there's a 35% tax rate, the highest rate for corporations. And so the deduction is just the amount that's needed to get down from the 35% in 2017, or if you're talking about 2018 inclusion, 21%, to the 15.5% or the 8%. And then, kind of interestingly, individuals, you know, as Ron mentioned, the transition tax not limited to corporations, even though they're the only ones that benefit from the participation exemption. So you could have non-corporate shareholders who actually are taxed at higher rates than a corporation generally, and because the deduction for the 965 amounts measured based off of the corporate rate, non-corporate shareholders may end up paying tax at a rate that's higher than 15.5% or 8%. And so that's kind of reinvigorated an old strategy or thought process of, might an individual consider making an election under Section 962 of the Code to be taxed as a corporation or taxed at corporate rates for purposes of Subpart F in order to get the benefit of the 15.5 or the 8% rate. So, as I mentioned, the key to whether you're subject to the 15.5% or the 8% rate is the aggregate foreign cash position. And the aggregate foreign cash position is measured, it's the greater of two numbers. So the first is the aggregate of the U.S. shareholders' pro rata share of each specified foreign corporation's cash position as of the close of the last tax year beginning before January 1, 2018, or the average of the aggregate cash position of each specified foreign corporation determined as of the close of the last two tax years ending before November 2nd, 2017. So in order to calculate the aggregate foreign cash position, it could be kind of a substantial burden going back in time that far and doing the calculations. So since the aggregate foreign cash position measures what is the cash position of the shareholder and of those specified foreign corporations, the cash position is defined as the sum of cash held by the corporation, net accounts receivable, and then the fair market value of a list of kind of liquid type assets. And there's discretion reserved for the IRS to identify other assets that are kind of equivalents to some of these publicly traded type property or other liquid property.
So what are the, I guess in looking at this definition, what are some of the issues that have, maybe been identified or raised at this point on how you calculate this?
Yeah, so, there have been a number of open questions and a lot of comments submitted to IRS that guidance is needed. So here's, I've kind of listed out a few of the questions. I mean, one is, okay, if the cash position's increased if you're in a net receivables position, well, what if you're in a net payables position? Isn't it fair to reduce the cash position by that amount? I mean, that seems equitable, and there's been no guidance yet on that. Kind of similarly, what if you have a short-term liability? Same kind of problem. The cash position, it gets increased if the corporation has short-term receivables, so why shouldn't it be reduced by a short-term liability? And then another one is just, what about if the corporation has blocked cash, if it's holding cash because there's some local law restriction saying they can't make a distribution, there's not really a tax deferral motive for keeping the cash offshore, it's just to comply with legal requirements. So, why should they be punished on the amount of the transition tax? And then just another issue, there's potential double counting issues when you have a U.S. shareholder that's got some foreign corporations that are calendar year and some that are fiscal year. You could have 965 inclusions in multiple years, and so there's just complexities about making sure that cash position doesn't get counted twice or doesn't get counted in both years. Just a word on offsetting the transition tax. So U.S. shareholders are allowed to reduce transition tax liability by foreign tax credits. However, the credits get haircut by the amount of the foreign taxes that are paid on the amount that's deducted from the 965 inclusion. And the percentages for the haircut they're hardwired in the code, and they're based on the 35% corporate rate. So that's the haircut amounts apply regardless of whether you're having a 2017 inclusion or a 2018 inclusion where the corporate rate is actually lower. And if there's any foreign tax credits that are disallowed under this transition tax rule, you can't credit those, you just kind of lose them. So another way to offset 965 inclusions with NOLs, U.S. shareholder might be in a position where they can largely use foreign tax credits to offset the transition tax liability, so they might want to not use NOLs to offset transition tax and might want to use it to offset other income. And so the code allows the shareholder to basically elect for the 965 inclusion not to be taken into account determining NOL deductions or the amount of NOL carryovers and carrybacks to the inclusion year.
And so I guess when you talk about NOLs, would current year losses be eligible for this election?
So that's something that's actually unclear. Under the literal language of the code, it uses the word NOL deduction, and under Section 172, NOL deduction is carryovers and carrybacks. But as a lot of people have pointed out, there's really no policy reason to limit the election to carryovers and carrybacks. And if you read the code that way, the kind of two prongs of what's not offset by the transition tax liability or by the 965 inclusion, it's reading those two to basically describe the same thing, so it kind of results in a nonsensical answer. Nevertheless, it's ambiguous, and so a lot of people have asked for guidance on that, but none has come out yet. So, U.S. shareholder, if you owe transition tax, you can pay that currently, or you can make an election. The election is due by the due date for your return to the inclusion year to pay the transition tax liability in 8 installments, and you can pay them without interest. So I guess if you're subject to the tax, it's not a bad deal to pay them over time. And here's the amounts of the installments, and then there are special rules that apply in the case of an S-corp shareholder. So IRS has been made aware that there are a lot of unresolved issues in computing the transition tax. So far they've put out 2 notices and a rev proc dealing with the topic. So we're just kind of have a list here of Notice 2018-7 included a lot of different topics where the IRS announced that they would issue regs. Some important ones, as I talked about earlier, there's some rules on avoiding double counting and calculating the cash position. And then the last one there, the clarification that a consolidated group is treated as one shareholder for purposes of computing the 965 amount. The second notice was Notice 2018-13, it's just some additional topics, other kind of guidance on the cash position, some other issues. And then, as Ron alluded to at the beginning of the presentation, Rev Proc 2018-17, this is guidance that the IRS put out under Section 965-0, which is a broad anti-abuse rule that gives the IRS authority to issue guidance to prevent the avoidance of the purpose of 965. So, as Ron mentioned, the IRS was concerned that taxpayers who were calendar year taxpayers were, changing the years of the CFC from calendar year to fiscal year in order to defer and possibly, leave open options to reduce the 965 inclusion. And so the Rev Proc prevents specified foreign corporations from changing their tax years if they would have had a December 31, 2017 year end, and it has a U.S. shareholder that would have a 965 inclusion. So while the Rev Proc kind of targets the strategy of changing the tax year, it doesn't completely shut down every instance of it, since it doesn't apply to corporations that already had a fiscal year end. And it also doesn't apply if the corporation, had more foresight and, made the election in a prior year to change its tax year.
Okay, so we kind of walked through this, the transition tax and all the mechanics of it. I guess one interesting thing that, being started to think about is what's the best way, or how should this transition tax liability potentially be handled in an M&A transaction? So if we think about, just think about a normal M&A transaction where you're out there going to acquire a target, just a cash transaction. And so, how should this liability be factored in, and how should it be covered, in connection with kind of your standard kind of, tax indemnity? I mean, is this something that, I guess perhaps, right, you could potentially use some type of purchase price adjustment mechanism where you attempt to kind of identify or ring fence the amount of the liability, and you effectively just deduct it from the purchase price on the front end? Or, I guess either in connection with that or alternative to that, you could also then just handle kind of through the normal pre-closing tax indemnity. I mean, those kind of seem like the options, right?
Right.
And then, I guess when you start thinking about that, though, at least one of the things that comes to my mind is, if you're doing, say, a front end, the deducting from the purchase price, how do you determine this liability?
Right. Yeah, I think as we've gone through, there's all these uncertainties in how you calculate the inclusion amount. So I think people are struggling with, well, how would you even estimate that? And then also just through kind of the diligence process of how much time do you really have to estimate that. And also, another issue might be, you could have a target company that has a subsidiary or owns an interest in a company where it's subject to the inclusion, but, if it's like a non-controlled company that they have an interest in, how do you even get the information from that company? And that's kind of beyond an M&A issue. That's just a more general issue, I guess.
Yeah, so it seems to me that, if you're going with kind of the deduction of purchase price, that you would almost have to tie that into some other form of an indemnity that, kind of backstops it perhaps, or I guess the parties just get comfortable that they estimate the amount and they kind of move forward. But, then I start thinking about, okay, well, if you handle it through the indemnity in any sort of fashion, what if the election here is made, right, to pay that liability over the 8-year installments, right? I mean, you have a tax indemnity now that could potentially last up to 8 years, which I don't think, most parties are comfortable with, right?
Right. Yeah. Yeah, you have lots of counterparties who don't want to have any sort of indemnity obligations beyond a few months, so 8 years is kind of a big ask.
Yeah, that would definitely be an extreme stretch from the normal situation. I guess, another way that you could potentially try to approach this, which would be similar, right, is that you're trying to backstop or I guess ring fence, right, whatever assumptions that you made for purposes of calculating, say, the purchase price adjustment. I guess there you can include some type of rep or warranty where, they rep to specific facts, one of them being is perhaps, right, the income conclusion or the liability will not exceed some threshold amount. So therefore, if our assumptions are wrong or some of the information turns out to be incorrect, we still have if you're on the buy side, right, the option to still recover through some sort of a damages type concept under reps and warranties.
Right. Yeah, and that's another one, I guess, when you ask how specific the other side's willing to get on giving a rep. Maybe they give some rep on assumed facts, and kind of then you're sharing or assuming the risk of, okay, well, how do we actually interpret the law?
And then finally, I think about how the normal kind of formula for pre-closing tax indemnity, the standard approach to it and the terms that are involved. I guess my final question then is, if you're in this situation where there could be this liability, does it need to be specifically accounted for in the actual definition or in the actual pre-closing tax indemnity? Because at least when I think about the standard language, I'm not sure if this liability, if it is paid over an installment process, if it truly would be captured. So I'm thinking that you would still want to kind of belt suspenders and make sure that the formula, or whatever the language you have on that pre-closing tax indemnity is broad enough to make sure that this kind of liability is captured.
Yeah, I totally agree with that. I mean, particularly if you're thinking it's a material amount, definitely better to make sure it's covered.
Well, these are, I guess, all kind of the issues now that are present with respect to the transition tax on the M&A side that, just, again, is interesting things to think about as these issues start to present themselves and how perhaps, the market will really start to handle them in the kind of the acquisition context. So now that we've discussed the transition tax, we will now move on to the kind of introduction to the new Quasi Territorial tax system. As John talked about, the transition tax is being imposed is basically the toll charge to get to this new kind of territorial type tax system. So before we kind of dive into the details of the new U.S. system, first we'll just walk through kind of the basics. What is a territorial tax system? Well, I think John mentioned too, a worldwide system taxes residents on its worldwide income regardless of source. So in a worldwide system, to basically avoid the potential double taxation of foreign income that could occur, the worldwide system typically allows a foreign tax credit to the domestic taxpayer, and ultimately the domestic taxpayer then is able to reduce its domestic tax liability with respect to foreign taxes that have already been paid on the same income. So that's the way that the worldwide system alleviates the double taxation burden. Whereas in contrast, the territorial tax system only attempts to tax the resident on income and profits that are generated within the domestic jurisdiction, such that, as a result of not taxing the foreign source income, there is no need then in a true territorial tax system to have a foreign tax credit mechanism. And if you kind of scan around to other territorial regimes that have been implemented, the primary, I guess, mechanism or the way that it's often achieved is through what is often referred to or discussed as a participation exemption. And that exemption basically exempts from domestic tax or imposes either a low domestic tax rate on certain dividends received from and gains recognized from the disposition of foreign subsidiaries. that's the common approach, and what we'll be referring to here is kind of the participation exemption. So if we kind of walk through a simple example just to kind of highlight exactly how the difference between a worldwide and a territorial system. Here in this example, if we assume we're under a worldwide system, you have, let's just say, foreign source business income of $10 million. You have 25% tax in the foreign jurisdiction of $2.5 million on that income. It leaves $7.5 million of profits to be distributed. Let's just assume now a 5% foreign withholding tax rate on that distribution. Ultimately, the net cash received is $7.125 million, and then ultimately kind of the additional domestic tax that would be imposed on that same earnings and profits would ultimately bring the total net after-tax cash to $6.5 million. Here, we're assuming a domestic rate of 35%, so your ultimate effective tax burden in this situation will be 35%. Whereas if we move now to a territorial system, we have the exact same facts, but now the dividend itself is not subject to an additional domestic tax because it's exempt under this territorial regime. So if you walk through all the math in this example, you're left with now a lower effective tax rate of 28.75%. And basically the moral of the story is that if you're under a territorial tax system and in a true territorial tax system and the tax rate in the foreign jurisdiction is lower than the tax rate in the domestic jurisdiction, you're going to be better off than if you were under a worldwide system. So now let's dive into the actual participation exemption that now exists under the new Tax Act. So pursuant to the Act, a USC corporation is now entitled to claim 100% deduction for the foreign source portion of a dividend, which also includes the deemed dividend arising under Section 1248 from the seller exchange of stock, received by such U.S. corporation from a foreign subsidiary corporation if the dividend is received from a specified 10% owned foreign corporation. The U.S. corporation is the U.S. shareholder with respect to such foreign corporation. The U.S. corporation is not a REIT or a RIC. And then a holding period requirement satisfied, which is basically a year, a 12-month type holding period requirement needs to be met. And then finally, the dividend cannot be what is considered a hybrid dividend, which is kind of generally defined as a dividend for which the foreign corporation received a deduction for foreign income tax purposes. So assuming all those requirements are met, a dividend or a deemed dividend arising under 1248 would qualify then for exemption under the Act's participation exemption. So now we need to dive into some of the terms and get a better understanding of exactly what those are. So the first one is, as we discussed, it needs to be a specified 10% owned foreign corporation. Well, this is any foreign corporation with respect to which any U.S. corp is a United States shareholder, other than a foreign corporation that is a PFIC, but that is not a CFC. So if you have a PFIC, then this exemption does not qualify. The definition also relies on the corporation, the domestic corp, being a U.S. shareholder. So this is a person that owns directly or constructively the stock of the foreign corp representing, at least 10% of the voting power or value of the foreign corporation. So it's vote or value for this purpose.
Right, and that's an expansion from the prior definition of U.S. shareholder, right? That used to just be 10% of the vote.
Yeah. So that is a very important thing to point out, that yes, that is a key change to the definition of U.S. shareholder in this new Tax Act, is that it is vote or value, whereas as John indicated, under prior law, whenever you're dealing with CFCs, the main focus there was on the vote. And then finally, that the holding period requirement would only be satisfied if the foreign corp is a specified 10% owned foreign corp, and the U.S. corp is the U.S. shareholder with respect to such corp at all times during that kind of 12-month period. And then finally, another kind of important feature of this exemption is that if you do have a dividend that qualifies under this exemption, it's going to, solely for purposes of determining whether there would be then a loss on the disposition of the foreign corporation stock at a future point in time, you would reduce the stock basis. So effectively, you're not going to get, in a sense, double benefit for this participation exemption on the U.S. tax side, meaning that your dividends are not going to be exempt from tax, and then you're also not going to be able to still utilize that same basis to then create a U.S. tax loss, on the sale of the foreign corporation stock. So if we really step back now and look at, you know, what the participation exemption is really doing, well, this territorial system is limited in reach, as it only applies now with respect to a U.S. corporation share of the foreign source E&P of a foreign corporation if the USC corporation owns at least 10% of the stock of the foreign corporation and the holding period requirement is satisfied. So again, if we step back, you know, what does this participation, it does not apply to, right, to certain things? Well, one, you know, it does not apply to pass-through entities such as partnership or S-corps. It's not going to apply to a REIT or RIC. It's not going to apply to individuals. And then even perhaps more importantly is it's not going to apply to the foreign earnings of a foreign branch, a disregarded entity, or a partnership that's directly held by a U.S. corporation, because it has to be held, this has to originate through an actual foreign corporation.
So I guess just kind of exploring that last point, so if you have a situation where a U.S. corporation owns so in our case, Canadian ULC, so a foreign entity, but under the check-the-box rules, default rule is it's a flow-through, so disregarded entity. So that means that's a branch or a disregarded entity for tax purposes, so income earned through the ULC, tax in the U.S., no participation exemption, just kind of general flow-through tax. But if you make a check-the-box election for the ULC, and so now it's a corporation for tax purposes, now it's a corporation, now you're eligible for the participation exemption. So just filing the check-the-box election gets you into the participation exemption. In this case, does that mean that if I'm a U.S. corporation that has a bunch of existing foreign branches, I've got a free pass now into the territorial system by just making check-the-box elections?
Yeah, I think you probably want to be a little cautious before you proceed down that route. So, you know, in connection with this, the Act also made certain other changes that will impact that check-the-box election. So just if we step back, so Section 367A1, you know, typically disallows kind of tax-free treatment, or that's the general rule under 367A1 is that what would otherwise be a tax-free type contribution under 351, you know, it will generally be taxable if the transferor is a U.S. person and the transferee is a foreign corp. Well, prior to the Act, one of the principal exceptions to this general rule was that if the assets were actually used in a foreign trade or business, that a lot of the gain that would have been realized in this kind of transaction was not actually subject to tax. It was not actually required to be recognized. So there was this key active trade or business exception. Well, the Act also now has repealed, though, that active trade or business exception. So now this means that additional gain would have to be recognized if you simply check or convert, you know, a directly held foreign branch or partnership into a corporation. So there needs to be caution, you know, before taking that approach that there is no longer this active trade or business exception. The Act also imposes this concept that if you are transferring substantially all the assets of a foreign branch to a foreign corporation, and to the extent that there was, you know, branch losses that basically reduced U.S., you know, taxable income, that those losses could also have to be recaptured and result in gain recognition. You know, there was a similar concept pre-Act in similar fashion, but the Act also imposes or has introduced a similar concept that existed before the Act. And then finally, another important feature about the Act is that it has now actually expressly amended Section 936H3B, so that expressly foreign goodwill, going concern value, and workforce in place are now actual true intangibles that are actually covered by Section 367D. So in addition to this active trade or business exception, if you have foreign goodwill, going concern value, or workforce in place, you know, that will also trigger, you know, some recognition event as a result of a check or convert type structure.
Right. I know the IRS had always taken the position that was already covered by 367D, and they put out the regulations a couple years ago, but now it's, you know, explicit in the code.
Yeah, and, you know, I think before, you know, under the regulations, and if you looked at the pre-Act law, you have some legislative history and things that were out there that provided at least a favorable argument on the taxpayer side to combat that type of position. But now, you know, that's all off the table since they've expressly included it. So go back to that simple example, you know, is it a simple solution to basically just check or convert? And unfortunately, most likely not. I mean, there's going to be a lot of facts and information that you're going to have to like dig into to see how costly that type of conversion would be, and then you would have to compare to what would be the true benefits of the participation exemption that you're getting into.
Yep.
So if we move on now, the next important thing to discuss in connection with this participation exemption is now looking, okay, well, how do foreign tax credits fit with respect to this exemption? You know, as I alluded to in the introduction, the foreign tax credits in a true participation exemption should just no longer be relevant because you're just not taxing any of the foreign earnings. Well, so similarly here, so to the extent that there's direct foreign tax credits that would be imposed on the dividends that qualify for the participation exemption, such as a withholding tax, for instance, you know, those would no longer be allowed as a foreign tax credit under this system. Indirect foreign tax credits also have been eliminated because the indirect foreign tax credit system that we had in place was set up specifically to apply to these type of entities now that get benefit of this exemption. So therefore, you know, the thought is, well, if you have income that qualifies, well, there's just no need now for that indirect foreign tax credit system. However, what's important, and as we'll kind of dive into as we discuss this a little bit more, is indirect foreign tax credits, however, still exist for subpart F income and for the new, you know, GILTI, which is the global intangible low taxed income. So there is actually a indirect foreign tax credit mechanism that applies to those types of income, and they're allowed specifically under Section 960. Now, the important features and the important changes that the Act has made to the subpart F, for instance, is they now basically determine the amount of taxes paid on a current year basis. So there's not this pooling concept that existed beforehand. And then specifically with respect to the GILTI side of the equation, it's purely just a current year type analysis, meaning that you cannot actually carry back or carry forward any of the GILTI related foreign taxes on your foreign tax credits position. So basically, in the GILTI scenario, you either use or lose your foreign taxes in essence on the foreign tax credit analysis. And then also another important feature about the Act's changes to the foreign tax credit rules that basically implicates this participation exemption is now there are actually separate foreign tax credit baskets for non-passive foreign branch income. So they've created this separate foreign branch tax credit basket, and then also non-passive GILTI. So there are these separate baskets that apply to those incomes.
Right. Presumably the concern there is that you've got kind of high taxed income earned through a branch or the non-passive income that's GILTI, that they don't want you kind of cross-crediting that with your subpart F income, which is probably subject to low tax. Yeah,
no, exactly. That's the exact concern that I think they were focused on.
Well, all that sounds pretty good. So why is it just a Quasi Territorial system, though? Why not a real territorial system?
Well, so that's why we, as you see, we've been very careful to label this as a Quasi Territorial system, and I think, you know, there's several reasons why we give it that name. Well, first, you know, this participation exemption, as we discussed, only applies to the extent of dividends or deemed dividends under Section 1248. And so in order to have a dividend or a deemed dividend under those sections, there actually has to be E&P, right? So the foreign sub has to have some foreign source E&P that it earned. So to the extent that you, say, sell a foreign sub and the foreign sub has only had a small amount of E&P that's actually earned, but let's just say it's gone up in value, it has this, you know, increased intangible value, well, that excess value that exceeds the E&P will not be subject to this exemption. That's still potentially subject to U.S. tax. So that's a key feature, and that's one reason why it's not a true territorial system, because in other jurisdictions you might see a true territorial system where all gain, regardless of E&P, is completely kind of carved out of the taxing jurisdiction. Another important feature as to why it's not a true territorial system is that the U.S. shareholders of CFCs, you know, are still potentially subject to U.S. tax on a current year basis for either subpart F income or the GILTI, which we'll get into in more detail in the next webinar presentation. But any amounts that get captured under subpart F or GILTI are basically currently includable as they are now, in essence, under subpart F principles. And therefore, you know, those earnings and profits basically are outside of this participation exemption, because you could have, obviously, U.S. tax as a result of the current inclusion. Thus, as a result of that, subpart F planning and structuring is still as relevant as it was ever before. However, you know, there may be a little bit different mentality under today's laws in the sense that in certain situations, due to perhaps your foreign tax credit profile, you may actually want to create subpart F income, right? Or create guilty. You may actually want to like get into this current year bucket because you may be better off through the foreign tax credit situation.
Yeah, which is strange to think about that you'd be in that situation.
Yeah, because I guess, you know, under pre-act, everybody was trying to avoid it because it was an anti-deferral technique, whereas now, as a result of not getting foreign tax credits on the participation exemption, you may be better off if you're actually creating subpart F income or guilty income. But if you really step back and you take into account, you know, items that are included in guilty, which we'll get into more detail again in the next webinar, and you really look at, okay, what does this participation exemption really apply to? Well, it applies to foreign E&P that's not, you know, U.S. effectively connected income or subpart F income. And then it specifically then applies to foreign E&P that's excluded from subpart F income under the high tax exception, foreign oil and gas extraction income, and then ultimately this 10% of a QBAI, which is kind of a tangible property investment, which effectively is an amount that's carved out of guilty. So when you kind of boil it down, you're really left with this kind of smaller segment of income or E&P that's ultimately left to this, you know, participation exemption. So that's kind of why, you know, when you really examine this, this is really a quasi-territorial type approach.
Right, and you can imagine that being very limited in the case of businesses in certain industries. You know, if you have a service business or something where you may not have much tangible assets, and, you know, if you're not in the oil and gas extraction business, I mean, it could be a pretty bad deal.
Yeah, so yeah, it may not provide a lot of ultimate benefit or as much as people had anticipated or hoped for before the Act's passage. So before we move on to the next slide, we are over 50 minutes into the presentation, so I'll read the CLE code. And so the CLE code is 27786. And again, that's 27786. Okay, so now we'll move on to the next slide, which is, okay, well, you know, as we discussed, what about Section 956, right? We have this participation exemption that exempts, you know, a significant amount of E&P from tax, and so Section 956 operates like subpart F or guilty, and would do this current year type tax, right? So if we're looking at E&P that otherwise wouldn't be subpart F or that otherwise wouldn't be included in guilty, why is Section 956 still around, right? So if you have our simple example where you have a bank that makes a loan to a U.S. company that has a CFC, if the CFC guarantees that loan, you know, that's going to create a 956 issue because that's going to be considered to be, you know, under the 956 principles an investment in U.S. property, basically.
Right, and that's even though, you know, the CFC, assuming the U.S. company is relying on its credit support, CFC could distribute an asset to the U.S. company or distribute earnings to the U.S. company, and there'd be no tax.
Yeah, so yeah, exactly. So yeah, if there's a distribution of the E&P, there would not be any additional U.S. tax, but nonetheless, you know, 956 was not amended or modified pursuant to the Act to account for this exemption, so therefore, CFC can distribute all of its earnings and profits, not be subject to any additional U.S. tax, but if it provides this guarantee to the bank, you're now subject to this kind of current taxation regime under subpart F. So it doesn't make a lot of logical sense, but that's the rule, and people need to be aware that 956 is still out there and can still trap unaware parties, especially in connection with kind of loan and credit agreements.
Right.
All right, so now that we have this kind of overview of the quasi-territorial system, you know, if you really kind of look at, say, a disposition structure, you know, I can now see a lot of different data points, right, that could come into play, and what are the things to think about as you're potentially structuring an act or a disposition. So in this example, we have a U.S. holding company that holds a foreign holdco entity, and that holdco ultimately holds another entity, which has made a check-the-box election to be disregarded. And so you have basically three separate entities in this example. And the ultimate operating entity is the disregarded entity. So one way you could structure this disposition is you have the buyer basically just buy the holdco stock for cash and just acquire the holdco. Or we could have the exact same structure, and now what we could have is we could have buyer form its own holdco entity because it's U.S. and it wouldn't want, let's say, a direct branch operation, but it would just simply form a corporation for tax purposes that's buyer holdco, and then buyer holdco would acquire the opco stock for cash, and then holdco then would distribute the cash to the U.S. holding company. So if we step back, we have these two alternatives. What are the things that we need to be thinking about to determine whether or not, what is the best structure here? So, if we look at the first alternative, if we assume that holding period requirement is satisfied, then any, Section 1248 gain, which is up to the foreign E&P amount of the holdco, should be exempt from U.S. tax under the participation exemption. However, as we described, it's only really a quasi-territorial type system, so any gain in excess of that 1248 gain would be subject to U.S. tax. So that's obviously, I think, one important key data point is, what is my 1248 gain versus what's the remainder?
Right.
To the extent that there were foreign taxes imposed on the disposition, those taxes would not be subject to a foreign tax, or not would be available for foreign tax credit purposes if they're attributable to that 1248 gain. Because again, anything that's any direct kind of foreign tax credits that are imposed are just not credible whatsoever if they're attributable to an exempt type dividend. I think another important, perhaps, data point is when you look at the GILTI and the Subpart F income, they're based on kind of the last U.S. shareholder for the tax year, in essence, for their kind of calendar, taxable year. So in this case, if the buyer was instead a foreign buyer, ultimately the amount of 1248 gain in that current year could be impacted by the current year GILTI or Subpart F, because the U.S. holding company would have been the last U.S. shareholder of those entities for their tax year if the buyer was a foreign entity. So that's another kind of data point that I think potentially goes into this analysis.
Yeah, I guess kind of similarly, if the buyer is U.S. and they want to make a 338 election or something to, kind of create the same effect, how does that work itself into your analysis?
Yeah, 338 is just another kind of data point that, and I think as we'll probably get into on the GILTI discussion, GILTI really, I think, changes a lot of the 338 analysis that existed, prior to the Act. So now if we turn to the alternative structure, right, which is where we sell the OpCo and then ultimately distribute the cash, I think some of the data points that we'll need to be focused on is, is the gain recognized by holdco, does it increase Subpart F income potentially? Does it result in GILTI? Or is it purely participation exemption E&P? Because if you can drive up your participation exemption E&P, then you could get the cash out basically tax-free, right? Or without additional U.S. tax. So that may, but again, it may be GILTI or it may be Subpart F. Again, you'd have to look at, are foreign taxes imposed on the disposition? Could such taxes be creditable if they're Subpart F or GILTI? And then finally, if you do distribute the cash out, would there be any kind of foreign withholding taxes there, right? And how does that impact your foreign tax credit position given this new participation exemption? So if we kind of just quickly walk through again some of the important data points here, I think as we kind of identify what you'd be looking at is, okay, what's your 1248 gain? What's your dividend distribution? How does your E&P situation set up? What is GILTI Subpart F income? Under either kind of transaction structure, how do those profiles look? Is there a benefit of increasing the E&P at the holdco level versus simply just selling the holdco stock? And then finally, if you really look at the foreign tax credit position, are there advantages, right, to incurring GILTI or Subpart F? Because say you have this additional foreign taxes that you've already paid that you want to use from a tax credit standpoint, so you may actually be better incurring the E&P and even in those forms at the holdco level. So I think those are kind of the data points that somebody would kind of walk through in connection with those type of dispositions.
Yeah, agree.
So then our final slide that we'll just briefly touch on because we are approaching the end of the presentation is, I think, one other kind of thing, that interesting concept is if you have, say, a foreign buyer, for instance, does it change now that we have this new act and this new participation exemption? Does it change to a foreign buyer where they now want to acquire, let's say, a target that's not U.S., right? Pre-act, pretty much if you had a ultimate foreign parent and you had U.S. operations, you typically kind of, kept those separate, and any other kind of non-U.S. entities or operations that were acquired were usually acquired in a separate chain, right?
Right, you wouldn't have a U.S. is not a very good holding regime prior to the Act.
And so now, obviously, the Act has changed a lot of the rules, so if we kind of look at this example where you have a UK parent with a US sub, would it now make sense perhaps to acquire this target under the US sub? You know, without going into a lot of the details, or, you know, obviously you'd compare data points, but if you just kind of look at a lot of the the generic data points, which is really to the UK side of the equation, I mean, I think, at least from my perspective or my conclusion, is it probably doesn't change things, right?
Yeah.
And I guess, and primarily because if you compare the corporate tax rates, you know, even the UK rate's still better. The UK kind of participation exemption is broader. It's not as limited. You know, it can apply to, you know, all gains or all dividends, for instance, and it's not limited. And there also is not this kind of potential guilty type regime that really imposes a minimum U.S. tax.
Right.
So I think, you know, when I step back and look at this, you know, I'm thinking that most likely on a going forward basis, that analysis still hasn't changed.
Yeah, I think that's probably right.
Well, I guess this approaches right up to the end of our hour, so we appreciate everybody joining us for the webinar and for part one of this three-part webinar series. And if you have any questions, please, again, email them to Megan Green at megan.green@bakerbots.com. And, you know, we announced the CLE code at right around the 50-minute mark, so please include that on the affirmation form, which you can download in the reminder email. And if you don't have this form, please email Megan Green, again, at megan.green@bakerbots.com. And then please join us again for part two of the webinar series, which will take place, I guess, 2 weeks from today. And in that series, or in that specific presentation, we'll be focusing on GILTI, FDII, and B. Thanks, everybody.
Thank you.